Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi everyone, welcome to the Small Cap Discoveries conference call. Today on our call we have Nick Blitterswyk, the CEO of UGE International. UGE trades on the TSX Venture Exchange under the symbol UGE and on the OTC under UGEIF. The company is trading at $1.25 with roughly 31 million shares outstanding, or about a $39 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks, Trev. Great to have Nick back. Nick, I think you may hold the record now for the most times interviewed by us. So congratulations. We'll send you a plaque here shortly. But it's been a little while since we spoke last. I think you had mentioned February. I lose track, but a fair bit has happened since February. Some good, some not so good. Great that you could be here to sort of clear things up and make sure everybody understands how things are going. And for those that are new, get to know a little bit more about UGE. So I'll hand it over to you.
Sounds good, Paul. No, thank you. And yeah, that's a record I'm happy to hold. So appreciate you guys inviting us back. And yeah, I guess it's been about what does that make it? 5 months or so since we were back on. So the business has been growing really quickly and evolving very quickly. So seems like a lot happens every 5 months these days for us. So in no particular order, the first thing I'll say is, when we spoke last time, we were just closing a financing. And so we did a 7 million Canadian bought deal financing that closed right around the same time, early February. And so, I know one of the questions at that point in time was, what are you going to put that to use on? And so, since then, we number one, we looked to grow the funnel further. And I think we had just posted some openings on our website last time we talked. And so, very happy with the folks that we brought on. So really good additions to the team. Kind of as an overlap with our goals are to grow our backlog this year to 120 megawatts, which in our conventional NPV measure would be in the 220 to 240 million USD type of range. So we added some origination and development folks. So we added someone from Nautilus, who's one of our competitors here in the Northeast and was bought by Power Corp of Canada a year or two ago. So we're very happy to have him on. That's Steve. Brought someone else, John, who's also a veteran in the solar industry. He's covering the sort of New York and some of the other states, a bit outside of New York City. And so he came on board too. And another John joined us actually from the oil and gas industry. So one of the states that we're entering this year is Pennsylvania, and he's based in central Pennsylvania. And throughout that, we're seeing really big growth in our pipeline and expecting that to be trickling down to our backlog in the months and quarters ahead. So we're excited with all the activity we're having on the funnel, and some of the remaining support staff that have joined the company as well. So, on the growth side, we feel like we're very much on track for that 120 megawatt goal this year, which would be a doubling from the beginning of the year. So we're excited for that. With all of our growth came some growing pains though. So, we financed our first projects last year, which included some aspects of IFRS accounting that were new for us. That includes tax equity transactions, number one, lease accounting, number two. We are leasing space on rooftops and ground mount and so on. And so there were some intricacies there that we needed to get up to speed with, including just the fact that instead of selling these projects or doing work for others, we were doing that work for ourselves. And so, Marissa joined us as our CFO last November, and she's been a great addition to the team. She really remade the finance team with the addition of a couple of key folks as well. And so as we were going through our audit, there was just a few things that weren't quite done right. And so that meant that we restated our Q2s and Q3s along with our completing our audit. And in addition, it was a lot of work, and so we were 1 week late from the typical 4 month deadline on our financials as well. So that meant that May, including the Q1s, which we announced at the end of May, was a very busy month for us on the financial reporting side. But we're very happy to have gotten through that, and I think that anybody who likes to geek out on accounting statements can take a look at our Q1s from this year, our Q1s from last year, and not that there was anything wrong with where we were a year ago, but the company has grown so much, and the quality of the financial reporting has grown with that. So with new CFO, a couple new controllers in place, we really feel like that side of the house is really solid, and we'll continue to build on that strength going forward now, and happy to have that behind us. I could probably keep going. I think on the last time we talked, I'll just briefly mention, on the Biden administration, that was a hot topic of conversation then.
Well, hey, Nick, why don't we do this? Just for the sake of those that might not even be aware of what UGE does, or new to the story, why don't we just backtrack a little bit, and let's talk about what UGE does first, and then we'll get into sort of some of the updates and some of the things that are exciting.
Sure. Yeah, of course. Thanks, Paul. So off the top, good refresher in terms of what we do, and actually, to put it really simply, we create and own solar assets. So we're out there creating these assets of value. We have our specific target market in terms of, number one, the mid-scale space. So generally, this was commercial and industrial. There's this big segment of that called community solar, which within that same mid-scale space. And so within that, we have 11 or 12 years of experience now developing those assets, engineering and building those assets. And then over the last year and a half, we pivoted to owning those assets as well. So those we see as the three legs of the stool. That's what we do. Roughly 90% of our backlog is in the Northeast United States, which is our biggest area of strength. And yeah, so at a simple level, that's what we do is create and own solar assets in that space.
Perfect. So now we can get into the other stuff, the more exciting sort of go forward stuff. So you've dealt with the accounting issues. Going forward, solar power is clearly, a very strong trend. We saw the interest from the investing community. Your stock hit a record high right around the time we were, last speaking. But the whole sector's come off a fair bit. Maybe let's talk about sort of where you see the short-term, mid-term future for solar in general, and then more specifically your company.
Yeah, I think that for the sector as a whole, as we're talking, I'll flip to another slide, and people have seen some version of this before. But for the sector as a whole, solar has become the cheapest source of energy on average in the United States and in many markets around the world. And this right here is from the Lazard 2020 LCOE, a levelized cost of energy study. So what that means is that solar is becoming more and more ubiquitous and is only going to become more so. The headline here talks about solar becoming 80% of all new energy deployed by 2030. 80% sounds like a very large number, perhaps depending on your background, a bit of a pie in the sky number. It was almost 50% in the US last year and over 40% the year before. So this is real, and it's happening very quickly based on the cost of solar. And I think that it's important to keep that long-term trend in mind when we think about some of the short-term variations. And I say that because one of the questions I've been receiving lately is about the input costs and increasing input costs. Panels, for example, we've seen a 2 or 3 cent per watt increase, which translates to, let's say, about 10% increase in solar panel costs this year. Solar panel costs being the second most significant input in terms of our costs to labor. So, in the short term, there's ripples, but macro level, we're just seeing solar become ever more cost effective. So that's number one. And then number two is, Paul, you started the question based on the shorter term stock market trends. But when I think about the medium and longer term, I first think about our 2024 goals. And that is, if I just flip to that slide real quick, so we want to have our first 100 megawatts of operating assets by 2024. So as a company, we now have actually we're over 500 megawatts of total experience now. And so on that basis, we feel like 100 megawatts is both about 100 times our current operating assets since we just started turning on our first self-financed assets since Labor Day. But on the other hand, a number that will just be focused on execution and seeing that grow. And at that same point in time, we look to be adding 100 megawatts of new assets to the backlog each year. So we see it as being part of a significant ramp up for the business. So very bullish on the solar sector as a whole, and also very bullish on what we can do here as well.
Now, I see down here a couple stats here: 50 cents a dollar per watt plus net asset value. I'm just trying to, when you talk about 100 million or megawatts of assets, what does that generate in numbers? Like what kind of money do you guys make from that?
Yeah, good question. So 100 megawatts of operating assets. If I go through it here real quick, if I start off with recurring revenue. So on a recurring revenue, you see here about 200,000 for each megawatt. So that would be 20 million. Now, just to kind of go a little bit deeper into that, our current backlog, if you look at the table, that number translates, I think it's to about 17 to 18 million. Looking at a few specific examples, you come out with numbers closer to that $20 million mark, but in essence, in that range, we're talking about recurring revenue of north of 17 million if we just be conservative on that. So recurring revenue in that type of range. Gross margins on that recurring revenue is in the range of 75+%. So again, just taking averages, I think it would be fair to say 13 million of gross margin on that 17 million of recurring revenue. And as you can see, I think I'm being conservative at each step of that calculation. And that's the gross margin. Our overhead right now is a bit over 3 million USD. With some growth, you might factor something closer to 4. The other way to look at it, just what it says here, this net asset value, and actually, if I just go back a slide here for a moment, that net asset value or net value retained, what we're getting at there, and there is, at a high level, our business is super simple. In the weeds, it gets fairly complex, but this net asset value is, again, the present value of the net value we're going to retain or receive to shareholders for these projects. So if I just go through this very simple calculation here, that 50 cents to $1 is the revenue minus operating costs minus the capital costs of the project. We do talk about this project backlog number, and that is a time at commercial operation. This is the $130 million our current backlog is, which is revenue minus operating costs. A way to think about that is kind of akin to a sale value. We started using that when we first were pivoting from selling to owning those assets ourselves. So if I go back to this slide again, the total value we'd expect to retain from 100 megawatts would be 50 to 100 million in terms of that net asset value of that. Just at that time, and then adding that similar type of business per year. One other, in terms of how we collect that net asset value, and I'm talking from a cash flow perspective as opposed to an income statement perspective, is a question for us of as we're building out these projects, we will typically pay ourselves a developer fee. We are the developer, we're the builder, we're the owner, and so the typical thing in our sector is that the developer collects a developer fee for doing that work. So there's some amount of value typically collect out of the projects up front, and then the rest would be through the positive cash flows of the project over time.
Gotcha. Are you capitalized? Like, do you have the capital you need to reach your 100 million or 100 megawatt goal? Yeah,
and we're feeling very good about our balance sheet. Actually, if you put like a side by side together, our balance sheet is by far the strongest or cleanest it's ever been now, having completed that financing earlier in the year. So we're really heads down on execution now of that. Of course, continuing to grow that as well. And yeah, so from that perspective, we no eye to doing an equity raise, and really just focused on seeing these projects enter the funnel, but then also come through the funnel to the point that they're being built and then that they're operational.
Mhm. Listen, at this point, I want to remind everybody that's listening, if you've got some questions specifically want to ask or have me ask Nick, please use the chat function on the side, and we'll do our best to make sure Nick can answer them. Nick, where do we go from here? Sort of the next 6 months, what are investors, what should they be looking out for?
Yeah, so the couple of things I would mention is, number one is, we, at the end of Q1, our backlog was 71 megawatts, and we're looking to get to 120 megawatts by the end of this year. So we definitely are telling everybody that we're expecting to be quite active in terms of our growth in that backlog between now and then. As we just walked through in terms of that value, we expect that that contributes to a lot of value for the company going forward. The other part is, our backlog now, depending on, we say an average of 2 years in terms of from entering the backlog to becoming an operational asset. We bifurcate that. The rooftop projects are more like 9 to 18 months. The ground mount projects are 18 to 36 months. I give that background because in 2020, we added most of our backlog. And of course, we've continued to add to it this year. And so on that basis, 2022 is where a lot of those projects start getting built and become operational. So that's another thing that we're looking to communicate to shareholders in terms of the progression of the pipeline and the backlog towards construction and then operational status, and seeing that happen with more and more projects. So we have a few that are going through the more deployment phases right now, but we see that to be ramping up quite significantly by around the end of the year.
Mm-hmm. And how do you get projects? How do you get one of these things in the backlog?
Yeah, so earlier I talked about adding some origination folks to our team, right? So we have people that generally focus on either rooftop or ground mount opportunities. The rooftop is very much a real estate game, where we're working with real estate owners that are, we've had a lot of our success with groups that are family offices or developers of real estate themselves, focused on distribution centers, warehouses, that type of building, office parks and things like that as well. Yeah, so it's a relationship game where there's a big land and expand aspect to things, where a lot of our clients are repeat clients, and we build out those relationships over time. And then on the ground mount side of things, it's a little bit more a strategy of what markets, what locations we want to identify land for us to lease that space and develop that. So the John, who started with us in Pennsylvania recently, he came from oil and gas, where he used to be leasing land for oil exploration, and now he's come over to the bright side, if you will. So it's really a matter of locking down that space, and then at that point in time, as we work the way through the project development cycle, it's working with the utilities on securing interconnection. It's working with the towns or municipalities on permitting. It's eventually gets to a point of closing on the financing for the projects, and seeing that become an operational project.
Mm-hmm. What keeps you up at night right now? It seems like everything is working out well, but where do you see the challenges for you guys over the next little while?
Well, I think an important milestone for us, given May being a bit messy, frankly, with financial reporting, was we wanted to get past that. I feel really good about the state of the overall organization and how much we've matured and grown here over the last year and a half. So that was a fairly grueling month, just with the workload and so on, as you can imagine. But really, right now, we're really focused on execution. I think that we've had some good members of the team join. I feel like everybody who's joined is now up to speed and really contributing to the growth in the business in their own ways. And so for us, as we push through to the end of the year here, it's there's a lot of opportunity in this space. So it's adding more projects to the funnel, but then also tracking these projects as they move through.
Listen, we've got a couple questions that come in. Why don't we just, I'll pepper you with a few of these as we go, and then I'll go back to some of my questions. So we've got a question regarding backlog, but looking a little further ahead, 2024, give us a sense of where you think a backlog could be by the end of 2024.
Yeah, if you take what I would call a conservative approach to that, this year we're looking to add 60 megawatts. If you did the same in 2022, 2023, 2024, that'd be another 180. So on the 120 this year, we're talking 300, of which 100 would be operational. So it gives you a sense of where we could be at by the end of 2024.
Okay, perfect. And then the listener here says, can you be more succinct? Is each watt you add to backlog equal to 50 cents to $1 in enterprise value, so that your backlog goal of 120 megawatts will be worth 0.75 times 120 megawatts? Does that make sense?
Yeah, makes perfect sense and very good question. And the answer to that is yes. So if I back up for a moment, one of the things that we've been really working on, and I believe that each one of our quarters has made progress, but I think our Q2 will make another good step here forward in terms of progress, getting down to that net asset value number. When we made the pivot from selling our projects to owning the projects, the natural thing that we did at the time was to say, we used to sell this project for $1 million, and that's based on a 10% post-tax unlevered discount rate. So we'll use that same number and talk about the backlog in terms of that value. As the business has evolved, it's very clear now that we're not looking to sell those projects on a one-off basis. And I'd be remiss not to say, on a one-off basis at the size of company, then you sell those projects for a lot less than you would as a portfolio, as a larger company as we are now. So in this case, 50 cents to $1. If you look at our backlog, on average, roughly speaking, that 100 megawatts would be about 200 million in terms of this net present value number. That's all in. But when you get down to the net retained value or net asset value to UGE, it comes out in this 50 cents to $1 range.
Okay, I gotcha. Now, earlier I interrupted you. You'd started talking about Biden administration, and I cut you off. So what was that you were starting to talk about?
Oh, I was just going to mention, I found it humorous, maybe even that well, I think if you look at solar stocks more generally, not just UGE, generally speaking, they are now down to values pre-election, never mind inauguration, pre-election. And that I think that's pretty interesting. Of course, my day job is running UGE, but in terms of the overall market, that seems to me to be an overreaction or overcorrection. So in early February, we were talking, there had been a tax credit extension under Trump in late December. And there was a lot of expectation around what might come through Biden, and the infrastructure bill, I don't think had been announced yet even. It was announced, I'm pretty sure, after the fact. So sitting here today, the number one thing I like to remind people, the Biden administration hasn't done anything yet for our sector. There's proposals, there's talk, there's desires of which ways they want to go, but it hasn't happened yet. And if you follow the US political news, in the last week or less, there's been increased discussion around the infrastructure bill that was proposed a few months back, and trying to either find a bipartisan arrangement that can make its way through, or get Joe Manchin to be so fed up that he sides with Democrats and allows something to pass with just the 50 votes. So that's where we're at right now. And there is a lot of push right now for a resolution of one way, shape, or form to come through. Now, my expectation is that our number one ask around reform of the tax credit would make it through. No guarantee of anything, but my expectation is that would make it through. And I say that because it's had bipartisan support ever since it was first introduced by President Bush in his second term. So I expect that to be part of it. However, there's a lot of other moving pieces right now too. For example, like the Senate Finance Committee passed a standalone investment tax credit bill that's been pushed through the overall Senate just in the last week or two. And so I do expect that now that the administration has its people in place and a movement's happening, that will bear fruit for the industry going forward. And I really don't believe that that's priced in any way. I think that if today's, using like university lingo, if today's course is like 201, and the first one was 101, reviewing our financial model would be 401, or maybe even a master's course. But sometimes, if anyone would like to reach out offline and get that sort of deep dive in terms of how things come together, I invite you to do so. But the point I'm getting at is there's this aspect of it where there's this investment tax credit. The way that solar developers monetize that is, in essence, selling it to tax equity investors. It's something that we've had a lot of experience working on on sort of both sides of the table, actually, as we've seen this industry grow. And we're expecting to have probably multiple tax equity closings this year. But there's an aspect of the infrastructure bill that would give you the option to just get a check from Treasury. And that would, in essence, take out a very thirsty middleman and make that process more efficient and also have a pretty nice impact to our bottom line as well.
Interesting. Now, earlier you had mentioned about the cost of sort of inputs or panels has gone up. What specifically is causing that? I mean, a lot of things. I mean, we're seeing inflation play out into a lot of raw materials and things like that. Is that what we're seeing here? Is it? Do you think it's sort of transitory?
Yeah, it starts with the raw materials, whether it's inflation or a bit of an asset bubble or whatever the case is, right? Mm-hmm. It seems like commodities have had a good run as well, and so on that basis, that's where it starts. There's a few other. I think, for example, the disruptions that we've had in the overall supply chains now probably started by COVID. There was also with the Suez Canal, right, where there was a ship that blocked that for a while. There's been those types of things at play as well. If I go back to the macro level here for a moment, though, what I would remind you is that number one is efficiencies are always increasing. One of the largest solar conferences is going on right now. And so if anyone likes to follow solar news and they don't already, I suggest signing up for something called Solar Wake Up. It's a daily email that just has about the top 8 articles of the day. And so this morning's email had at least one or two articles about announcements from there. Mm-hmm. The point being is efficiencies continue to increase. Efficiencies lead to better economies of scale and so on. So macro level, that's helping things. And then number two is if you also follow the supply chains very closely, the amount of gigawatts of supply coming online this year, like they have been every other year, but especially this year, is going to lead to further downward pressure on supply costs too. So, again, medium term, we're pretty happy that we're going to see continued downward pressure on those input costs.
I mean, that's generally been the trend for the last 20, 30, 40 years, I think, is all those economies of scale are starting to factor into much, much lower prices for product.
Yeah. We used to have a chart in our presentation. We don't have it in there now, but the first time we bought panels 11 or so years ago, $3.80 a watt. It was talked about $1 per watt was the holy grail. We get there, game over for fossil fuels. Depending on the market, we're at 20 to 35 cents per watt now.
Yeah, that's amazing. Okay, so one of the listeners wants a little clarity on one of the answers from earlier, but he asked, do you have enough cash to execute the backlog or not?
So the answer is yes, we believe that we do. I guess to go into any more detail, I mean, I think that the number one is that we're getting heads down on execution of this. As soon as projects get get into stage 5, as we call it, where they're in deployment, it starts generating positive cash flow for us. It also, we have an extremely clean balance sheet now too. So as and I mentioned that because, you know, how do we fund these projects? Well, there's the tax credits, and there's also the construction level financing as we deploy these projects. But we have very good lending relationships to, you know, move these projects through financing into operation very quickly. So that's where the focus lies.
Maybe roughly how much capital do you have to come up with to do a project on a percentage basis? It sounds like a down payment on a house. You don't have to come up with the full amount, obviously. What sort of down payment do you have to come up with?
I really like that you asked about the house, and the reason I'll say that is, like, let's say that UGE was instead of creating and owning solar assets, let's just say that we were a real estate company, and we were buying apartment buildings. So what you'd expect is, let's say I was buying a building for 10 million. Well, I probably need to put up 2-3 million, something like that, right? Now, in our model, if we were a renewable IPP, that would in essence hold true. If we were out there buying a portfolio of solar assets, we would need to come up with our equity. It would be we'd have a debt piece to it, etc. However, in our model, because we are the developer builder, and actually as we're talking, I'll go over to another slide here. But because we are moving these projects through, when we structure the financing, there's the project level debt, of course. There's also the investment tax credit and so on. But the thing that we're creating is so much more valuable than what we started with, that our equity contribution is actually negative. We take out a developer fee and own the equity in the project in doing so. So to answer that question, you know, we have our overhead, right? So there is this aspect of, okay, we have our overhead and we need to be doing enough projects to generate enough cash to cover that overhead. But once we do, it's like, you know, every time we win another megawatt, that's another net add to the value that we're creating as a company.
What happens if a building, you know, that you guys are leasing, what if it gets sold? How does that impact your business?
Yeah, so, you know, we do have a long-term contract. We do have what's it called, a non-disturbance agreement that we require the building's lenders to sign as well, giving us you know, free title to that. So we're with the building. If let's say that it's a warehouse, and right now it looks like an industrial area, but with development it's going up market, and someone wants to tear that down and build a high rise. They would need to buy out the system, and that buyout is in essence a net present value calculation of the project at that time. And so from UGE's perspective, we're kind of neutral actually in terms of if that happens. And I like to say, if that were to happen, let's say it's just a typical warehouse, and now we're building a $100 million high rise. Well, paying UGE, you know, $1 million or whatever the price would be at that point to buy out that project is probably not going to be too big of an issue. So we feel we're pretty well covered there. We insure all of our systems for, you know, all the typical you know, natural disasters and everything else as well.
Gotcha. Okay, next question. Your revenues are fairly fixed over the long term. How will UGE deal with a rising interest rate environment in the future? And then same question with inflation. Do you guys have enough margins built in?
Yeah, you know, I'll go in reverse order. So in terms of inflation and margins built in, right now, earlier I talked about the solar panel prices increasing, you know, 2 or 3 cents per watt. It's still within our contingencies that we hold on projects anyway. And so on that basis, and I'll say that macro level, we're talking about how we expect these costs to be coming down over time. We don't model that. You know, typically that's added value that you're able to capture if and when that happens. So so we feel good in terms of our ability to withstand the fluctuations that we're seeing. On an interest rate side of things, there's a few factors at play. So number one is, you know, the question was asked as though interest rates will rise, which is to be determined. But to the degree that interest rates are rising, let's say they rise 100 basis points, 200 basis points over the coming years here. Well, UGE is also scaling up significantly, and I can't emphasize this enough, that the interest rates that we're paying now are a lot higher than we'd be paying at a larger scale. And in more than 200 basis points, if I'm just comparing a few examples in my mind right now. So we have this natural, as we grow, a natural counterweight to increasing interest rates. Another thing I'll say, people often ask about like the refinancing side of things. Our typical project life is around 25 years. Our typical debt, the most common that we see in this market, is a 20-year amortization with a 7-year term. Why is 7-year term chosen? A big part of the reason is because the way tax equity is structured, that's typically a 5-year term. So the debt at 7 years is now after the tax equity has already exited the project. And I say that because now, if you imagine that project, instead of closing on debt as the project's being built, we're talking about a project that's been operating for 7 years. It does not have a tax equity partner involved anymore, so just one less hand in the pot. And so, all things considered equal, we'd expect cheaper debt on that as well. So we can all imagine scenarios where interest rates go much higher than we're foreseeing. And to that, I would say, going all the way back full circle to inflation and so on, we'd also expect us to be signing contracts with higher electricity prices, higher inflation escalators, perhaps at that point in time. And there's also a natural counterweight in our business from that phenomenon as well.
A couple of times earlier, we touched on the fact of higher input costs, specifically for material. How do you guys mitigate that? How do you deal with that sort of fluctuation? I mean, you guys are ultimately the owners. Is there any kind of pass through, or do you just have to sort of suck up the cost?
Well, if say we sign a contract to do a project, right? So we're going to build a project, and it's, earlier we talked about time frames. So let's say that this project's going to be built 1 year from now, and we're going to pay a certain lease rate on that. Now we've calculated that lease rate based on our expectations for everything that comes together, and we hold contingencies on that as well. Now, I've never seen for UGE, I've never seen a project that was economical and then things change, like input costs, and makes it non-economical. However, in that case, our lease with our real estate owner, they're locked in. We do have outs, actually. Like, we don't need to build that project. And I think, actually, I didn't mention this earlier, but typically during the development cycle, there's a grace period where either you're not paying a lease, or you're paying a very, very low lease for that time period. So, let's say that something happened where a project was not economical, we don't have to move forward with that project. And so, so we do have and I think actually, with that, with that perspective, let's say that the whole sector was suffering from the same phenomenon. You wouldn't expect one company to have it worse than others. And let's say a building owner was expecting $20,000 for a lease, and now the economics say that it could only be 15. We're the incumbent. We've got the interconnection. We've got the knowledge of the building and so on. We also, I'm proud to say, every relationship with our real estate owners that I can think of is one that it's a strong relationship, often with repeat business. And so our opportunity to say, hey, you're also aware of the inflation that's going on in this hypothetical scenario. And so now that economics comes out at 15, I think that quite likely we'd be able to work out something in most of those cases.
Let's jump, into the future here. And you've, 3, 4, 5 years down the road here, you've got, this is sort of a capital intensive building up front, or project up front. But then it's very, very low OPEX from my understanding. So at some point you hit that point where the cash is, you're going to have a lot of cash coming in. What do you do? Do you double down and just grow faster? Do you start, delivering cash back to investors? what do you do with the cash flow, 4 or 5 years down the road?
Yeah, I think it's a good point, because if you think about that medium to long term, it's a business that does generate significant cash. And so the uh, the short answer is we see ourselves growing to a point where we are a business that's calculating cash flow available for distribution and being able to pay a dividend off of that. We see this as like to start with, our concept of long term is a decade. And we see this decade as being very, very ripe for development of these types of projects. We want to be pragmatic and methodical about picking ones that are going to give us that 50 cents to $1 plus of net retained value on a per project basis, and seeing that continue to scale. Right now we're of course looking to generate, to put that money back into the business. We want to be a lot larger than we are now, and see ourselves as much larger than the current market cap is right now. But that is the medium to long term goal for sure.
And I want to be clear. I said it's a capital intensive business, but it's not necessarily your capital that you're using. You're using somebody else's capital. But my point was, there's a large upfront amount of cash that goes into building these things, and then it's just cash after that.
Yeah, that's right. 100%. I go back to that apartment example, right? It's like, it's actually, I don't personally know of another business that's like that, where instead of needing to put down money towards it and constantly be tapping the markets to do so, you're actually creating something financeable of value in order to scale that up. So yeah, so it's funny, we often use the term capital light model. It does depend on how you look at it. Right. And I think the other side of that is, I touched on this a little bit earlier, but in terms of the overall market for debt, it is a market where, whether we're talking about pension funds or various infrastructure funds or insurance companies and on, there is such a huge appetite for the long-term yield of the types of projects that we're developing. So we really see ourselves as that platform to be able to provide access for those types of institutional investors to play that role.
And I can imagine right now is the sort of the loans that you're getting, or the debt capital you're getting, is it project specific, or do you ever, you can package these things up, and then the diversified portfolio is going to allow for much lower sort of risk and interest charges. How do you handle that right now? Yeah.
And to get specific, I think the way you asked that question, gave me an idea to better answer a question I asked earlier. The last debt close we had was at 5.9%. That was a project specific perspective. You see portfolios of assets, and that's senior secured at the project level. You see securitization of assets in the very low twos. Right. So we're talking about, call it 375 basis point difference between that. That's a diversified portfolio of assets. And so we see that same type of opportunity, and whether that's through securitization, green bonds, institutional investors. I've seen in the 2 point something type of interest rates for diversified portfolios in the private markets as well. So to answer your question again specifically, but slightly different, as we see that portfolio mature, we'll move more and more to portfolio type of financing on the debt side, still non-recourse to the parent, but for the reasons that you mentioned.
So, I mean, potentially then there's a couple solid basis points reduction in interest charges if things were to sort of, if interest rate environment stays the way it is right now. As you guys mature, you can take advantage of that, call it securitization of your debt then, right?
Yeah, exactly. Yeah, and I said it in a different way before, but we definitely feel that will be happening as the portfolio grows.
That's fantastic. Listen, I mean, I know a number of listeners are fans and know the story fairly well, but we always like to let you guys have sort of a parting message or key takeaway or anything you think investors should really leave today with. And, what is that message? What should investors really know about UGE that they may not know now or should?
Yeah, I think I made the mistake off the top of jumping right into the specifics without remembering about the overall company. But number one, I just want to thank yourself, Paul, and Trevor as well for the opportunity to come back and give an update. And a lot has been happening, so I'm glad to have that chance. But if I just go through like a high level, bringing it all together. So number one is, the self-financed aspect of things. We have over 500 megawatts of experience doing these types of projects. We feel very comfortable executing on the various stages of this. Even the financing, we used to work with financiers of the projects who sat on the other side of the table, and now we're playing that role. But even that is something that we actually have a lot of experience and know really well. So I think from that perspective and from other perspectives, we're very poised for a lot of growth here. And that speaks to the backlog and how we see that growing and so on as well. The way that we bring all this together in terms of being the developer, the builder, and the owner operator, well, that helps with this capital light model, as we called it earlier, and our ability to scale up on a fairly light capital operating, at the operating level, a fairly capital light model. And then just going here. And number four is we talked about the community solar market and how much that's growing. The investor presentation's on the website, but there's a map of the United States in there that that shows the Northeast U.S. is pretty much completely colored in now. And one of our goals this year is to add three states. We've already now added two in Maryland and Pennsylvania. And so we're seeing UGE grow within that pretty quickly here. And I think it all comes together. Balance sheet's very clean, strong, and the backlog, of course, is very good. So we see a lot of growth ahead of us there.
Mm-hmm. That's great. Nick, we've been following you guys for quite a while. You've come a long way, certainly since the last couple of years that we reconnected. I want to thank you for joining us today. I want to thanks for the update, and look forward to the next 6 months, and hopefully have you back in in short order.
Yeah, sounds good. No, thank you so much. I got to keep that record holding status. So I appreciate it, and and our contact information is here. Myself and Marissa, our CFO. So anyone can feel free to reach out anytime.
Perfect. Thank you so much, Nick. Thanks for joining us.